Hey guys, how's it going? Solo back here with another weekly Sunday update video on my thoughts for possible options, trade ideas for this coming week. And as I always do, the first thing I look at is to see what tickers have upcoming earnings this week, because usually that means that they're going to have juicy premiums. So taking a look at this week that's upcoming, not a lot of names stick out to me. The one big name that sticks out to me on Monday after close is going to be Zoom. So as you know, during this illness, Zoom got a huge run up because everybody's working from home or doing schooling from home. So a lot of companies like Zoom, Skype, Microsoft Teams, they're getting more popular, right? So I know the premiums on Zoom are going to be juicy. We'll do a calculation to see how juicy they are, but that's a little bit on my radar. The only thing about Zoom right now for me, and I'm sure for a lot of other people, is that it is very expensive. It's very pricey. So I personally will not be able to sell cash secured puts on it. So if I do want to play it, I may have to sell a put credit spread or a call credit spread, depending on how I want to play it. The other ticker that stuck out to me was DocuSign, which has earnings Thursday after close. And again, this is another one of those tickers that has really flourished during the illness because, again, people don't want to meet in person to sign paper documents, so they send these e-documents through DocuSign to legally sign papers. So I know a lot of people that are purchasing homes, you would normally have to go to the office to sign the paperwork and buy the house and your mortgage and such, but now companies can just use DocuSign and you can do it remotely from your home or even your phone probably, and that way you don't have to risk getting sick. So those are the really only other two companies that stood out to me. I know some of my viewers have played CloudStrike and Cloudera. I personally don't know exactly what they do, but I think they're also in the realm of kind of or internet companies. So I know, or I've heard at least, that they've been doing well as well during this illness, but again, I'm not too familiar with them, so I personally am not comfortable playing those companies. If you've played those tickers before or you know more of what they do or what their business model is, please leave a comment below in the YouTube sections and educate me and maybe some other people. The other companies that just kind of stick out to me are Five Below, which if Dollar General and Dollar Tree did well last week, Five Below is another one of these kind of discount stores where everything is in general about $5 or less. So it might stand to reason that if Dollar General and Dollar Tree did well, then maybe Five Below will do well as well. So we'll just keep an eye on that one. Macy's, Macy's I think is on the verge of going bankrupt, so I really don't want to touch that. And other than that, I haven't really heard of any other company that has earnings aside from H&R Block, but I don't want to mess with that right now because I personally don't want to mess with any financial or banked tickers just because I don't think that industry is doing well despite what the stock market says. So let's take a look at those tickers. So the first one I mentioned was Zoom, and like I said, it's very pricey. It's $300 a share right now, but as you can see, 3 months ago it was only $172, and again, I put only in quotation marks, but if you go back a year, it ran up from sub 100 and basically 3x'd all the way to 300 in less than a year, but in about, I would say, 6 months, which has kind of been crazy. So we'll have to see. One thing I will note is just be careful whenever you're looking at earnings dates in general, because sometimes websites will have conflicting data. So one thing I noticed was if we go to Zoom on TradingView, it actually says Zoom's earnings is in 5 days, and it actually shows on the graph that their earnings are on September 4th, which is actually not true because, as I just showed you, Earnings Whispers shows that their earnings are this coming Monday after hours. So then to confirm that, I also went on Robinhood, scrolled down to the bottom, and Robin also says that their earnings are August 31st after hours. So in this instance, TradingView is actually incorrect. So this number is incorrect and this date is incorrect. So just be careful in general with any ticker. I always try and confirm the earnings dates with multiple websites just to make sure that they have the same date, because there have been times where if I just looked at TradingView and didn't look at Earnings Whispers or Robinhood or any other brokerage that reports earnings dates, I may have played this incorrectly. So just always do your due diligence and double check the earnings dates. But let's just take a look at Zoom on Robinhood. Like we said, let's take a look at the options chain to see how juicy the premiums are. So let's just say I want to sell a cash secured put expiring this Friday on Zoom. The at the money premium is $1,935 for 100 shares, because as a reminder, every contract is 100 shares, divided by your collateral or your risk, which would be $300 per share times 100 shares. So it'd actually be $30,000, which is again why I would say I don't personally have enough capital to sell even one cash secured put on Zoom. But like I said, if you do still want to play this ticker, you could take advantage of the juicy premiums and play spreads. But let's just see how juicy the premiums actually are. So, wow, I'm actually very shocked. These premiums are incredibly juicy. The at the money puts have a 6.5% return on risk, which is actually very appetizing. I can't recall the last time I saw a ticker have this juicy premiums at the money. So, like I said, if I do want to play this, I can't personally sell puts because I don't want to spend, I mean, even if I go down to, let's say, the 260s, which would essentially be all of my capital. Well, actually, it wouldn't even be all my capital because I have some money tied up in Virgin Galactic shares, and I also have some collateral tied up in my QQQ spread. But let's just say hypothetically, I had all cash this week. So this would be a return on risk of $460 divided by 26,000. So let's just see how juicy this premium is going to be. So this premium would be, or this return on risk would be 1.8%, which is still very good. So, you know, this might be on my short list of, not in terms of selling a cash secured put, but in terms of selling some form of a spread, whether it's a put credit spread or a call credit spread. Now, the only thing that worries me about Zoom is that I think it's overvalued personally. I think this run up has just been fueled based on, you know, hype because of the illness. And I don't truly believe that Zoom is a $300 company, especially because they have so many competitors that basically do the same thing. They have Skype, you have Microsoft Teams. I mean, even Discord has a screen sharing or streaming service / a voice chatting service. And I will tell you personally, because I've used Zoom, I've used Skype, I've used Microsoft Teams, and now I'm using Discord. I will say of all those platforms, Discord actually has the best voice quality, and actually, in my opinion, has very good streaming quality that's right up there with the big boys. So I don't really know if Zoom is a $300 company, and I'm really concerned that if Zoom doesn't have good earnings because maybe they lost market share to these other companies, maybe their stock is going to drop. So if that's the case, if you're bearish on a ticker, then you can get a call credit spread. So you can play spread to the upside, hoping or thinking that the ticker is going to drop in value, so that way you can collect your max profit. If you're bullish on a ticker, you can play a put credit spread, thinking that the stock is going to go up, same as a cash secured put, in that in your mentality is that you're bullish on the stock or ticker, and you can hopefully get max profit that way. So it's going to be interesting. I'm going to have to definitely think about this a little bit more to see, A, if I do want to play it, and B, if I do decide to play it, do I want to play it on a bearish side or on a bullish side? Leave a comment below to how you would play it if you decide to play it, and let me know what strikes you would want to play. But stay tuned for my video on Monday to see what ends up happening. But that's the one ticker. And DocuSign, you know, it has a similar story. So let's look at DocuSign on Robinhood, just the same way we did with Zoom. So DocuSign, again, it's still a pricey ticker. It's $100 less than Zoom, but it's still pricey at over $200. But again, if we look at the 3-month graph, it's up almost 58% over the past 3 months. Over the past year, you know, this graph looks nearly identical to Zoom. It's up over 370% in the past year. So same idea. Their business is kind of flourishing because of the illness. But the one thing about DocuSign that is different from Zoom is that they really don't have another competitor. I mean, I've signed a lot of e-documents and e-forms over my time, and they have always been a DocuSign form. I've never come across any other company that has the same business, essentially. And if they do, as far as I know, in my circle, no one's really using it. So if I had to choose right now, without even looking at the premiums, I would say DocuSign. I have a better or a more bullish sentiment on DocuSign than I do on Zoom. But let's take a look at the options chain to see how juicy the premiums are on DocuSign. Because I will say 6.5% at the money return on risk, that's really hard to pass up. Again, nothing I say in any of these videos or in the Discord server is financial advice. I'm just merely sharing my opinions based on, my due diligence and what I find. But let's see. So it'll be $1,338 of premium for $21,500 in risk, because that's $250 per share times 100 shares. So that return on risk is, wow, pretty much just as juicy at 6.2%. And you know what? Right now, between the two tickers, I would be more inclined to play DocuSign personally, because one, it's $100 cheaper, and the premium is pretty much just as juicy. So I'm going to keep this one kind of on the top of my list once the market opens tomorrow morning to see which I want to play. But again, this would tie up a huge chunk of my portfolio if I do decide to sell a cash good put. But again, I could sell a put credit spread, because I think personally I am more bullish on this ticker. So if I sell a put credit spread, let's just take a look at some of these strikes. So let's say I go down, I want to play it safe. So let's say I go to 175, okay? Because let's just see what the return on risk would be, because 175 to where the strike is at 216, I mean, we're a good almost $40 away from that share price. So I think if DocuSign does go down after earnings, I hope it doesn't go down, by $40. That would be a $40 decline in a $216 stock would be an 18% decline, 18.5%, which would be pretty significant. I mean, DocuSign would have to get hit pretty hard. But like I said, I would only imagine that more and more people and more businesses are using DocuSign nowadays. And honestly, even when the illness is over, it's so much more convenient to just sign forms over the internet on your computer, on your phone, or on your tablet than it is to drive to a physical location, sign paperwork for a few minutes, and then leave. So DocuSign might have a good business just moving forward, even if the illness gets better and clears up. So let's just take a look at that return on risk at 175. $103 in premium divided by 17,500 in collateral. So that's going to be a return on risk of 0.6%, which is not bad. My personal minimum is about 0.4, and 0.6 is not bad, especially because I've never played this ticker before, so I want to play it a little bit safe for the first time, and because it's earnings. So, if I do want to tie up 17,500 of my portfolio in one cash good put, I could earn a max profit of $103 this week, which would be a 0.6% return on my risk, which is not too shabby. Not bad at all. I wouldn't complain about that. I mean, $100 on 17.5, that's really good. But if I wanted to play it a little bit safer and reduce my max loss and also reduce my buying power requirements, I could sell a spread at, let's say, 175, 172.50, because then my max loss, it's going to be a monetary value. It's going to be a dollar value, and I have very little risk of getting assigned shares. So what I can do is my max loss is going to be the difference between these two strike prices. So 175 minus 172.50, and that's per share. So my max loss is $2.50 per share times 100 shares. So my max loss, if I were to sell this spread of 175, 172.50, would be $250, and then my max profit is going to be the difference between these two, $103 minus $72. So my max profit is going to be $31. Now you may be saying to yourself, wow, you basically reduced your max profit by 2/3 as opposed to just selling this cash good put. And you're correct. However, I also reduced my max loss in terms of the nominal value by a significant amount, because my max loss on a cash good put is essentially tying up $17,500 in shares as opposed to just flat out losing $250. And to prove that to you, if I do a return on risk calculation of this spread, it'll be $31, right? Because that's what I calculated as my max profit, divided by my max loss, which I calculated as $250. So my return on risk is going to be 12.4%, which is way more than the 0.6% I just calculated on my cash secured put. And then the other side benefit of selling this put credit spread is that if you have a broker and you have margin and you have buying power, you're only going to reduce your buying power by $250 because that's your max loss on the spread, as opposed to reducing your buying power by $17,500 for just the cash secured put. So spreads are a little bit riskier if you want to think about it that way, because your risk is not now getting assigned shares. Your risk is just flat out losing money. However, as we've always stated in our videos, the more risk, the more reward. So as you can see, spreads are a little bit riskier. However, your return on risk is significantly more. So that's what's offsetting it, right? So that's what makes spreads worthwhile if you want to think about it, because yes, you are taking on a little bit more risk, but you're also going to get a little bit more reward as opposed to cash secured puts. So it's up to you to decide what you want to do, but I will say that that does look a little tempting, this 175, 172.50 spread, because even at 175, there's a 91.5% chance of profit. So by selling this spread, I would say statistically, based on this math, it's unlikely that DocuSign is going to drop to below 175, 172.50. And if it does, you're going to be out $250. However, the con or the negative is that you're only going to make $31. But as I said, you're only tying up $250 of your buying power. So if you really wanted to, you could sell more than one contract. So let's say, you really wanted to make $100 this week. So you could just sell 3 of these contracts, right? So sell 3 spreads and you would collect $31 times 3. So, it's about $100 there. It's $93. And then obviously your max loss is going to be $250 times 3. So your max loss is going to be $750, but your return on risk ratio is going to remain the same. So you can sell multiple of a contract. So even though a spread will net you less max profit, you do have the ability to, if you have enough portfolio and buying power, to sell multiple contracts. So those are really the only 2 plays in terms of earnings plays that I've been looking at this week. If we just take a look at some of the tickers that I always look at. So right now, if you remember from my videos from last week, I have essentially 2 positions on right now. I have 200 shares of Space or Virgin Galactic, and my cost basis at the time I got assigned shares was $19 a share. Yes, it's been reduced a little bit because of my premiums that I've collected along the way, but just to keep a simple and easy number to remember in my head, I just remember it as $19. And so I have 200 shares of Virgin Galactic at $19 a share. So that means that I have 200 shares times 19, $3,800 of my portfolio essentially tied up in Virgin Galactic shares. However, last Friday, or 2 days ago, I opened up 2 more covered calls for this coming Friday, September 4th, for $31 a contract. So my max profit for this week on my 2 Virgin Galactic covered calls is actually $62, right? Because 31 times 2. And I'm actually hoping that Space does rally to 19 or higher, because I just kind of want to free up this $3,800 that I have in Space shares. I've kind of been bag holding it for a little bit. I've been bag holding it for, I want to say, about 3 or 4 weeks now. And it isn't a large part of my portfolio, but I'm at the point where I just want to free up that capital. It seems as though the sell-off on Virgin Galactic has kind of tapered off. You can see on the squeeze indicator here, if I zoom in, we're a little bit bullish in the sentiment. The RSI is basically near the middle. You can kind of see this curve has kind of started to taper off. So maybe around the 17s is kind of the bottom right now on Space. So because of that, the other thing I want to do this week is I think I'm going to open up some cash secured puts on Space. And I think I'm going to open up a couple of them just because the ticker is so cheap compared to what I usually play. And the reasoning is twofold. One, let's just take a look at the options chain. One is because, of all the tickers I usually play, Space still has pretty juicy premiums. So let's just take a look at the at the money put. It will be $42, right here, divided by $1,700 in collateral per contract. And as you can see, that's why I love Space, because yes, you may argue it's a little bit of a meme product. They don't have a good business, blah, blah, blah. At the end of the day, if they're making me money, they're making me money. I'm not saying and I'm not telling you to hold Space for the long term because they're an amazing company. They're going to be the next SpaceX. No. The point of me trading options right now is just to generate cash flow. If a ticker is making me money, then it's working. So that return on risk is going to be 2.4%, 2.5% almost, which is not bad because actually if you looked at my videos from this earlier in the week, that's usually the premium that like AMD has been giving you lately, and this is much cheaper than AMD. AMD's trading in the 80s right now. I think mid to high 80s at last check. I mean, Space is in the mid to high teens. So much cheaper stock for the same return on risk. So if you do end up getting assigned shares, again, just like my 200 shares, you're not bag holding that much money of your portfolio. You're not, tying up that much collateral. So the other thinking is, I'm looking at the $14 strike, to be honest with you, because it's far out of the money. So it's unlikely to get assigned shares, hopefully, unless some bad news breaks on Space. And like I said, looking at the graph, it looks like it's kind of leveling off around the $17 mark. But not only that, it'll serve a couple functions because I'll collect a little bit more premium. So I'll be able to further reduce my cost basis of what the shares I currently own are, which is a win. And if I do get assigned shares at 14, let's say Space does drop to 13.5 on Friday. If I do get assigned shares at $14, and let's say I sell 2 of these contracts to kind of equal out the 200 shares I already own, then my cost basis is going to get reduced, right? Because I'm going to own 200 shares at 14, 200 shares at 19, and if I just divide by 2 to average them out, then my cost basis is going to be about $16.15 per share. So I'm happy with that if I can reduce my cost basis that way as well. But like I said, it's been really tough this past week or so finding some good setups and good tickers to play with juicy premiums to make it worthwhile. But I think I will open up a few contracts on Space at $14 because at $5 a contract for premium divided by $1,400 in collateral, the return on risk is not great, but it is just about 0.4%. It's actually 0.35. So it does fit my personal kind of minimum threshold of where I want to open up some puts. But, I could sell a bunch of these. I mean, I could really sell, 10 of these if I wanted to. And then that way my max profit would be $50. And then I could get assigned, the potential there though, is to get assigned 1,000 shares of Space at $14. But, looking at this graph of Space, I kind of drew this trend line here a while back because it looks like ever since about mid-April, Space hasn't really broken below $14. I mean, high 13s, low 14s. So the other thing is that this Fibonacci level, this 23.6% Fibonacci level, is right here at about 16 and a half or 16 and some change. And you can see it got really close to testing that Fibonacci level, but then kind of bounced off it. So if I believe in this Fibonacci level holding as support, and then if not, this trend line holding as support, this trend line that I drew is pretty much at 14. So I think I'm pretty safe at selling $14 cash grid puts on Space. And I would say out of all the tickers I've looked at last week and so far, this I think is my best possible play personally for this coming week. And again, I'm not telling you that this is what you should do. Nothing I'm saying is financial advice. I actually don't want you to copy my trades. I'm personally just saying this as my thoughts and ideas of what I may do. But let's just take a look at AMD because I always look at AMD. AMD was up another 2% on Friday. It's crazy. I mean, there's people on TradingView that are calling for AMD to break out above 90, which it's crazy to think about it because just a few weeks and months ago, I was talking about AMD in the 40s and 50s and how $50 was too much. And now we're talking about AMD in the 80s or 90s and, probably soon to be over 100 where it'll double where it was just a few months ago. But it's just crazy to think about what AMD's been doing. But like I said, the premiums on AMD just have not been juicy enough for me to risk that much collateral in my opinion. I mean, let's take a look at the option chain again in terms of selling some puts because I don't have any positions open on AMD. The $198 in premium divided by $8,500 in collateral. So the return on risk is going to be 2.3%. So actually Virgin Galactic was a little bit better return on risk at the money. And this is about a third of the return on risk on Zoom and DocuSign this week. So yeah, I don't know. Something needs to happen for AMD's premiums to get juicy again. But I feel like it's getting a little stale in my opinion. The other ticker that I've been looking at this whole week was actually going to be Micron. Because if you watch my videos, I've been watching Micron do this huge sell-off. And I've been kind of saying, where's going to be the bottom? Because that would be the optimum point if you could time it perfectly, if you had a time machine, to open up some cash secured puts. And you know what? I think I may have missed the bottom because it looks like 42, 45-ish, 42 and some change was the bottom, because look, it started rallying back, dipped a little bit, and then set a higher low because it went from 42, 45 to 44. Now it's rallying again. You can see the squeeze indicator showing bullish sentiment. However, RSI is showing a little bit overbought. So I think we may have missed the bottom on Micron, but I think that's good knowledge, because to me, I read this as, okay, Micron is at right now in the short term at least a $42 stock. So if I can get in on a cash secured put around 42, you might be safe, or less. Actually, if you can get in like 41, 40, then you might be safe. I mean, if you take a look dating back, Micron only went down into the 30s during peak illness. Then the next higher low was about 40, then 41, then 42. So it looks like, even dating back for the few months, like low 40s is kind of the baseline right now for where Micron would trade. So knowing that, I did take a look at Micron options, the option chain. But again, the premiums on Micron just have not been that juicy. Again, selling puts, let's just say at the money, would be $94, right? Divided by 45.50 in collateral. And that return on risk is going to be 2.1%. So even less than AMD. So it's great. I mean, I would say it's good, but it's not great premium. I think we can squeeze a little bit more juice out of some other tickers. So that's really what I've been looking at this weekend as far as plays. I mean, Tesla, it's going to be really interesting to see what Tesla and Apple do this week, because this is the week of their split. So we'll have to wait and see if Tesla and Apple are going to rocket off now, because the share prices are cheaper. So people on Robinhood or other brokerages that maybe couldn't afford shares of Tesla or Apple will now buy into those tickers. I mean, yes, on Robinhood, if you had fractional shares, you could buy fractions of these tickers, but not every brokerage right now has fractional shares. And then the other option is, was this huge run up already pricing in the inevitable split that was announced? So are we going to have a big sell-off, meaning a lot of profit taking on Tesla and Apple this coming week? It's going to be really interesting. I personally will probably stay out of Tesla or Apple, at least on Monday, just to see what the market is going to do and how the market reacts, because I really don't want to end up owning Tesla or Apple, at their peak and then riding this huge wave down, because that would tie up a lot of collateral. If I do decide to play Tesla or Apple, I mean, because I frankly, aside from Apple, I wouldn't really be able to afford any cash secured puts on Tesla. They would be spreads. So we'll have to wait and see, stay tuned to my weekly videos to see what happens day to day. But really the only other ticker I had on my radar was silver. I played it 2 weeks ago. I didn't play it this past week. It kind of traded flat to rallied a little bit. It's funny because on Thursday, Jerome Powell basically announced, or kind of admitted, that inflation was going to happen, and they're going to try and keep it at 2%, but I don't think anybody really believes that. And you would think that because of essentially everyone agreeing that inflation is going to happen, that people would pour their money into commodities like silver and gold, but you really didn't see that. Silver and gold got somewhat of a boost, but it didn't really take off like it did earlier back here. So it's very interesting to see what silver and gold are going to do this week. But I play silver because gold is way more expensive and silver is a much cheaper ticker. I mean, it's only $25 per share. So again, if you do get assigned shares, it won't tie up a lot of your collateral as if you were to trade gold. But this was a little bit of a longer video, but I did have a lot to talk about. But again, nothing I say in these videos is financial advice, just my thoughts and ideas for this weekend, for this upcoming trading week. You'll have to stay tuned for my daily update videos to see what plays I actually end up making. But again, my intention or my goal is not for anyone to copy my trades. If you're in the Discord server, you know that. And just as a quick plug, if you're not in the Discord server already, make sure you check it out. These are the last few days to get in before we go paid. So if you want to check it out while it's still free, get on in there. There's a lot. I cannot say enough good things about the people in there. I mean, they're absolutely amazing, very knowledgeable, very friendly, and very helpful. I mean, truly, in our Discord server, there are no dumb questions. So whether you are a complete beginner that doesn't even know what an option is, or whether you're a seasoned trader that's been trading options for 50 years. Everybody is welcome in the Discord server, and everybody is very helpful and willing to share their thoughts and their opinions. So make sure you get in there if you're not in there already, and follow me on Twitter. But as always, happy trading.